Hey everybody, this is Paul making a quick end of the month video here. Well, sort of end of the month. Was going to wait until the 31st to get a full accounting of March, but I'm doing a slight portfolio update. And then I wanted to go over some things in the bond market that are about to happen that the bigger market is going to react to. Um, so, by my math, since my last video, I believe I am up with today's gains $3,500, give or take a little. Because my last video I was at 53,565. There's a specific reason that I made that video on the 15th was to to figure out before the Fed meeting where was I at, and after the Fed meeting where was I at. Um, So I guess the first thing is why is the market up? So like what in the world's going on? Because if you look at this is going to be a negative number, but and this doesn't even include my other portfolio. Where's it at? So this doesn't even include my other portfolio, which is this right here, which has that amount of money in it. So you have to include all of these. So it's kind of like that right there. And then I guess you would probably add probably another $400 today. So what exactly is going on? What are my plans? What am I going to do with this money? Um, so as it stands right now, a lot of people are trying to figure out, well, why is the market going up? Why it doesn't make any sense. The Fed's raising rates, and you have to kind of go back into history, and it's kind of formulaic at this point as to what's going on. So you see the market up big time today. This is on like Ukraine, Russia news, but you have to kind of look through that and figure out what's going on. The VIX, the volatility index is very far down. Okay. Um, so you have the Nasdaq up also. You have oil down a lot. This isn't going to show up at the pump anytime soon because, of course, it's not. Wheat's down a lot because they think Ukraine's going to recover overnight or something. Natural gas is down a little bit. Oil's down the most. The market is pricing in something I just don't see happening. But any bad news out of Ukraine and a lot of this reverses. Oil goes back up to like 107 or whatever. And so you have to kind of look through all of this and look at it. So what I'm looking at right now is if you look at that right there, that's 6 basis points. That is when the yield curve inverts. And that's a signal that so that's considered a signal as to within 12 to 18 months there will probably be a recession. And the reason why is because the Fed is raising rates with the sole intention of controlling inflation, which they can't control. The only way you can control the current inflation is with a recession. That's just facts. I don't know why nobody wants to say that. They're saying stupid things like, oh, well, they're going to raise the unemployment rate. Well, they're trying to raise the unemployment rate so that it's very strange. But it's going to end in a recession, um, or at least that's what the market's pricing in. Um, so there are higher rates on the short end, lower rates on the high end, or on the long end, or on the middle of the curve right here. Means you're going to get higher rates, and then long-term growth is going to be slower. If they thought long-term growth was going to be like we were going to have like super high GDP numbers, these numbers would be taken off much higher. But that's not what's happening. So at some point, you're going to see a big headline that says 2's curve inverts. That's just kind of a signal. As it stands right now, you see the 5 year and the 30 year. You can get more for a 5 year U.S. Treasury. And you see these two kind of bouncing up off of each other. This is going to invert higher. So That's a market signal as to what's going on. So, what happens? Like, why is the market going up? And to figure that out, take it out to the 5 year, or you could take it out to the 20 year, or whatever year. But when the Federal Reserve starts hiking the rates, the market tends to try and throw a big party, I guess is one way to word it. So if you know a recession's coming, you're going to try and make as much money as possible and then move the safety and then wait for it to fall and then try and get back in at the low. This is kind of the pattern. It's hard to see on this chart, but maybe if I take it out to this chart, this is a good example right here. So the market did this in 2019 and nobody really realized. So the Fed was raising rates a lot and they were rolling their balance sheet off at the same time. The market rallied and then started to tank. And then the Federal Reserve said, "Oh, we changed our minds. We're actually going to take rates back down to zero," and everybody's happy. So the party kept going. What happens is that that makes a fragile market even more fragile because you're feeding more money into companies that are bad. So you can see it happening here. Low rates, everybody's good, everybody's happy, and then you get a one little event, well, big event, the coronavirus, and then it knocks it out completely. And you can kind of see what's going on now. So there's a thing called a melt up, and what a melt up is, it's effectively for a lot of the market just shoots higher for no specific reason, just blows through previous highs and just goes higher, 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 higher until it gets to like a tippy top and then it effectively falls. You kind of saw it right here. It's easier to see on the longer term charts. You can kind of see it just does these things called melt ups. It's hard to see right here, but that's kind of what this was. You can kind of see. So they do these things, and it might be easier to see on other charts, but effectively the market just kind of it might be easier to see on an S&P/Y or SPY chart, but you can kind of see it does like a big rise and then it does a major fall. So same thing here, right here, big rise, and then it just starts to fall until it just bottoms out at some point, which is typically the median line. So if you kind of draw that line right there, you see how those points touch right there. So what the market is kind of priced in right now, and especially, and if I had the graph in front of me, you would kind of see that the yield inverted in here, the yield inverted in here, and the yield inverted in here, and kind of it inverted right here in 2019. But it's a market signal. So when that happens, that's when people start positioning for this, I guess, melt up. But then they also start taking profits and putting it into safety. So it's just a signal. So that's what we're waiting on. So what am I doing in response to this? Like, what is my portfolio? Like, what do I got going on? So right now my portfolio remains very heavily tech focused. I got in on these right here at extreme lows. I wish I got in more, but I got in on these at extreme lows. Um, like you can kind of see from the 15th when I made that video, it's already up 20%. Just yesterday it was 18. The day before that it was 17. I have a feeling that by the time that this goes all the way up, this one share right here as an example is going to end up being up 60% from where it was. So if the market does drop 20%, which is entirely possible, we will, yeah. So there we go. So that's where we're at. Um, so why is there a huge cash balance? Like what's going on there? So basically, I got rid of three things because I'm going to take profits, profits, and pay off this credit card thing I got going on here. This is a legacy thing that I was going to pay off later on, but I'm going to do it now. So that would basically lock this as kind of my current. So something like that. So that would be the current. Um, I don't think this yearly dividend amount is correct because I just sold those stocks and instead of going down, it went up, which means E-Trade's doing some weird stuff. When I did the math, this came out to 2,900, 2,900 or so. So I think that's what this is going to end up being once it settles and everything's figured out by tomorrow. But I think that's where that's going to be. So in my next video, so this video is going to have the big number with the big rise. You know, it's going to have this number plus my other account. So it's going to have that, like whatever this is today, minus the, it's going to have this number. So that's what this video, that's the point. Like, so it's going to have this number plus whatever the gains are today. But the next video is going to have this amount right there subtracted. So that amount right there subtracted completely. So that's just kind of weird. So it's going to look weird. I'll make a video probably on the 15th, 15 days into April. I believe it's April, right? April. But 15 days into April, just kind of going over that, and you'll see that drop in the title of the video. So it's not the market crashed or anything. It's just that basically I'm just taking profits. I think that might be the last time I take profits prior to what I believe could be a recession. So if you go out to a calendar, when a recession might be, depends, really does. The market's pricing in a lot of hikes, and I think the Fed's going to go right along with them. So the expectation is March, but there's no telling what the Federal Reserve's going to do, because the Federal Reserve could easily, it all depends on inflation. So if inflation goes down, then the Federal Reserve will not move as quick, and you could extend this out from say 12 months to 18 months, which kind of coincidentally takes you out to like basically October, which is a very historic month for crashes. Market really likes to crash in like this August and October time range. It's just because it's after summer. A lot of people are positioned in very different positions, and you just, just the market's in a very different place at that point in time of the year. You can kind of see already this rally right here. So what I did is I sold 3 stocks. I sold Pepsi, NRG, and I sold PPL. NRG and PPL are 2 utility stocks. They don't like higher rates. But they were two stocks that are two stocks that were paying kind of lower dividend yields, and then also Pepsi was paying a lower dividend yield. I would normally never have touched Pepsi, but it was just a low dividend yielder out of everything that I had to choose from, and I just kind of got rid of that one. So that brings my total holdings here. One thing you do notice, I did get rid of AT&T. I might add it back in. I was waiting for this, and if you notice, where is it at? There it is. They changed their dividend. So what I'm waiting for is for this stock to settle. So they put out their, so you see how it still says Warner Media segment and all this over here. So what I'm waiting for them to do is to spin off their Warner Media segment into that WBA stock or whatever that is. Like spin that off, and I want to see what it's going to do to the stock price. I have a feeling the stock price is going to go down to 19. So I'm waiting for that to bottom out, and I'll get back into it, which means this dividend yield might probably end up going up to about 5%, but I'll probably end up going back into AT&T, but I'm not touching it right now because of kind of when they spin off the Warner Media stuff into that WBA or whatever shares. I'm not sure how much that's going to subtract off the top of their value. I think that's going to subtract maybe 40 billion off the top of their value, and I'm not sure how the market's going to price that in. That could be a lot. I mean, it could go down to 15 potentially, but that's a total guess. Like that is a flat out guess. It could go down to 15. It could go down to 17. It could go up. I just don't want to be near it when it does what it does, because there's literally, if they put out a statement in their thing where they said what they were going to do. It's probably somewhere on here, but if you're an AT&T shareholder, you can look up the statement that they put out. But basically, it says that investors should be prepared for volatility, I guess is the way they worded it, but that effectively means when they spin this off, the value of your company drops because you're spinning off a huge section of your company, and that's supposed to happen in April or May, I believe. But I don't want to go near this stock until then. So yeah, even though the dividend yield looks good and the price looks amazing, you might be saying to yourself, "Oh, that's great. That's a great no." No, because you could take a hit on the stock price and never recover it. It could be sitting at a $17 stock for a few years. So that's why I'm not going near AT&T. So what did I do with the AT&T shares? Um, I actually distributed between these two stocks. So AWF. Well, let me do AFB first. So AFB is basically Alliance Bernstein. They're a like a mutual fund. I think that's what they're described themselves as. But so this is a municipal bond fund with a 5% yield, which means it's tax free. You have to go to their website. Like you actually have to go type this into Google. It's right here. So if you go over here, and I'll link this in the description of the video if you want to go read it. But so this is AFB um, holdings and characteristics. So you see what they hold. So they hold municipal debt. The one thing when it comes to municipal debt, I used to hold a lot of this stuff, like a lot of this stuff. But the one thing that I normally hold, or the one thing you normally have to check on this, is the quality of the debt that they're holding. So if they're holding a bunch of trash debt, that like might default if you go into a recession, which rarely happens. Like if the only time that that would happen is like if you got like Puerto Rican debt. That's the only time it's really happened. But if you see, so you see a lot of theirs is AAA, AAA. Um, yeah. So that's kind of what I was doing there. So that's basically a tax-free income source. Um, that's how that's taxed. And then you have AWF. AWF is kind of, where are we at? There it is. So AWF is effectively a, I guess the best way to think of it is like a small business loan type thing. I looked into their holdings. It takes a second to pull up their holdings because there's so many, but it'll pull up in a second. But they loan out to like smaller businesses. So when this actually does pull out, you'll see that they have like all of it's divided up by states. So you can see they do loans to different businesses. This one will move if there's like a breakdown in credit. So if we ever do get into a recession, this one will actually move down. You can actually kind of go to the chart and see what it does. The best example, because this is it's like a Main Street lender, like they lend to Main Street, and you can kind of see what happens. So we get into like something that brutally hits Main Street, you can kind of see that the stock goes from, so right here it went to about 728. And if we go like say a 10-year, let's go out to max. And you can kind of see what happens. So here's the last recession, or here's the tech recession. See, I went to 7. And this one right here. So see, I went to 7. But you see how it also quickly recovers. So when they think the economy is going to slow down, this is one that's going to get hit. So you can kind of see right there, it went down, did the same thing, and then this is like the most recent one right there. So you see 728. So I expect if there's a recession, without a doubt, this one's going to get hit right here. AWF, like this might end up probably saying like negative 700 or something like that in a recession. Um, it pays a huge dividend because effectively they're just straight up passing on the profits from the small businesses that they're lending to. So you can see where their distribution is, where they do their business at, that kind of thing. And they have, if you want to look at their detailed reports, they're right there. I'll link both of these in the description of the video if you want to review them. AFB is just one where I just kind of park money right now. is to have a place, basically just a steady income source. Very nice little spot to have it going in at. And then we have these two right here, BST and then BSTZ. This right here, like if I was going to tell somebody where to maybe invest in, even though this one's up by a dramatic amount, like 20% what I showed you, you can still see it still has a long ways to go to get back to where it was. So if this recovers to anything of where it was, it's going to go up by quite a lot. That's if it recovers to what it was. But the reason why I'm not recommending BST is if you look at that, it was at 58, now it's at 44. In a perfect scenario, if rates go back down to zero, yeah, this could go back up. But I think BSTZ has more to go. But that's just a guess. If I was going to add money anywhere right now, it's going to be AFB and it's going to be BSTZ. Because like I said, during melt ups, what happens is like as the market is going up, you can see the volume's crazy right now. E-Trade's even having trouble processing. But as I'm pretty sure that the NASDAQ is going to recover a pretty big chunk while people are just sitting there scratching their heads trying to figure out why it's recovering so much. So that's kind of where we're at right now. So right now, just kind of trying to reduce my debt, anything I can take out, and then basically get everything down to a core set of like bills, I guess if you want to call it, and then basically have the dividends paying everything so that when I go into a recession, when we go into a recession, which I believe is going to happen, we're long, but if we go into a recession, then the portfolio is taking care of everything that I have, and then basically I'll be able to buy things cheap as they come along. And if you can see, there was a chance there to buy things cheap in February and March. Because for some reason, people on Wall Street apparently just do not go outside, and they thought we were going to have a recession in this March, like right now. I don't know what the hell they were pricing in or what world they live in, but unless there was like a COVID lockdown and I didn't know about like a worldwide lockdown, we weren't having a recession in March. Sorry, just wasn't happening. Like there's everything else, like the jobs report, the housing report, nothing indicates that that was coming. Is it possible in 12 to 18 months? Without a doubt. Is it possible right now? No. I mean, unless something dramatic happens, but you can kind of see this might invert while I'm on this. You can see it right here. Just invert it. There, or no, almost. Right there, you can kind of see. You'll probably see a big headline here pretty soon, but 6 basis points. That's nothing. That's literally nothing. This is the 7 basis points right there. You can see these two are getting closer and closer. Um, they might equalize out. They might be able to buy some time here pretty soon, but at some point, and you can see it. You can literally see what's going on. The market rallied a lot today. People took profits from positions that were risky. You can see it. You can literally see it while I've been making this video. Market rallied up. People took profits. Now they're piling into the 10-year in a big way. Or now they're piling into safety. Or wherever they're putting money into, they might be putting it into cash. They might be putting it into somewhere else. But that's going to be the pattern for the rest of the year. You're going to see these big pops, and then you're going to see a sell-off as people go into safety until they get a lot of their portfolio. And then as soon, and I guess one good example of that is probably BND. You can kind of see this is a really good example of that. This is a massive bond fund. Go out to the 5-year, but look what happens. It goes up in a straight line. See how it goes up in a straight line? So right here, Fed started raising rates, 77, 77, boom, 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 boom. And then it goes really quickly. And then as soon as you get the recession, everybody pulls their money out and then goes into like all that money that gets pulled out. We're talking in the billions right here. They yank the money, and then as soon as they think we hit that bottom, they pull the money and then go into like back into stocks. into whatever's like probably tech, which is because it's going to have low rates. But you can kind of see the little pattern. That's the spike on something like this is what you're looking like. So that's one place you can kind of look for indicators as to kind of what might be coming. But yeah, that's where we're at right now. So like I said, I don't think we're having a recession anytime soon, and I'm going to take profits on just my low dividend yielding stuff. I'm leaving everything else as it is right now. I don't see any reason to touch anything, and I'm just going to be basically adding positions, increasing my dividend yields per month, which I'm currently at. I thought I showed this, but there we go. So you can pause on the video if you want to see that. But this is where we're at per month, and then that's where we're at, and this part will soon be gone. So there we go. So I'll let you know if there's any updates. My next video should be April 15th, and then we'll just go from there. Alrighty? Thank you so much if you listen to this whole thing. Have a nice day.